Morning, welcome to Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Reema Tendulkar and Hormis Patakia. Good morning, guys. It's a Thursday morning. Feels like a Friday already, actually. It's been such a long week. But in terms of the market moves, we saw Nifty surging yesterday, led by banking names. But today, it has come in for some profit booking, taking some rest right now. But for now, if you look at the Nifty, it is down around 56 points. Midcaps falling more. So 0.5% gone there. But there has been a wee bit recovery from the lows as well. So keep an eye out on that one. Even for the midcaps, we have seen a sharper recovery from the lows around that 10:30 a.m. mark. If we talk about sectoral movers, of course, Reema will talk about Nifty IT in greater detail. Infosys continues to be in focus and the other IT names as well. But it is IT which is putting pressure on Nifty today, while Pharma is batting for the bulls. So 0.5% higher on Nifty Pharma. Auto index also doing well. A lot is happening around tariffs with respect to the US, with respect to UK, India, FTA. So definitely auto space and auto stocks will be in the wait and watch mode.
You know, and once again, India is underperforming the Asian market. So Nikkei continues to do well. Hang Seng has rallied 3.5% this week. The Chinese markets are up 2%. The Nikkei market is up nearly 5%. I think once this India-US trade deal is struck, there will be that, the release or the relief coming through in the markets, and we would perhaps break out of this range. But as you rightly pointed out, it's mildly lower now for the benchmark indices, down 0.25%. The Nifty is at the 25,160 mark, a cut of 60 points, and it's IT which is exerting pressure. The Nifty IT index, contrary to everyone's expectations, because we thought today would be an IT day on the way up, it's turned out to be an IT day on the way down.
And on the way down, and how? Take a look at Persistent, take a look at Coforge. Reema will just talk about both of them in just a bit. We'll also put the spotlight on Infosys. Guidance raised, but yet the stock is lower. But just before we get to that, there are plenty of earnings reactions that are taking place in today's session. Senor's Pharma is one of them, and that stock is now up 11.5%, the top gainer on the BSE small cap index. Thyrocare is the other one. That too is trading with gains of around 11%. Force Motors, that is up 9.5%. PNB Gilts came out with results yesterday during market hours. The stock didn't do much yesterday, but now is up 9.5% in today's session. So plenty of earnings reactions. And on the downside, if you take a look at, besides what Reema will just speak about, the IT names, the other names on the downside include Spandana Spurti, that's down 7%. Lumax Auto is down 7%. UTI AMC reporting results today, that is down 5% as well, ahead of the results. So a lot of these asset management companies are reporting results today, along with the likes of Motilal Oswal and the likes. So we keep an eye out on all of these names. But the spotlight has been on IT, the spotlight has been on Persistent, on Coforge, and on Infosys. What exactly transpired, Reema?
Well, first let's look at the way the stocks have corrected, right? It's a very, very sharp decline, not just a mild pullback or profit booking. This is a correction, 7-8% gone on the benchmark IT companies. Now, there is no problem with growth. Growth has beaten expectation. Growth is very strong across the board. For Infi, 2.6%. For Coforge, it's about 8%. Persistent, 3.3%. The management commentary on growth is also very strong. Coforge, for instance, saying that H2 is going to be materially better than H1. Persistent also talking about how, the aspiration of $2 billion revenue top line is very much intact. So then why are the stocks correcting? Let's talk about Infosys. Here, the only reason could be that the upper end of the organic guidance has been trimmed by 40 basis points. Let me explain that. The current guidance, the previous guidance was 0 to 3%. Now the guidance stands at 1 to 3%. So the upper end has remained unchanged at 3%. That's the max in terms of growth. The earlier guidance didn't include acquisition benefit of 40 basis points. The current guidance did. So basically, 3 months back, the best case organic growth was 3% for this year. Now it will be 2.6% because the balance will come from acquisition. That could be the disappointment when it comes to Infosys. Now, when it comes to Coforge, it could be on two folds. One, on margins, and two, on their capex. Now, the company has said that their margins are at 13.2%. unchanged quarter on quarter, and they're on track to achieve 14% margins. But I spoke to a lot of analysts, and they're saying this 13.2% margin includes a lot of one-offs that the company has done. So, for instance, there is a bonus issue, ESOP cost, there would be the forex element to that. If you strip that out, then the margins are actually a lot lower. It differs. Different analysts are putting it, at different numbers, but the adjusted, the margins X of all the one-time adjustments that the company has done is actually a lot lower. Also, secondly, this capex spend, right? On an aggregate, the company has done a capex spend of $85 million, but it includes about a $65 million capex spend for a data center, which they will be using for their clients. Historically, IT companies have never put in any capex. This was a very asset-light business. The only expense that they had was their employee. They used to provide services. But now they're investing in capex also. Right? So there will be the depreciation cost. So, analysts are a bit puzzled and they're questioning. Why? Because the costs of running a data center are also fairly high. And that has also resulted in the cash flows being on the negative side. Now, Persistent, that's the third one. Here, maybe you can quibble on the growth because 3.3% falls short of the CNBC-TV18 poll. Plus, the wage hike has been deferred by 1 quarter. And third, the deal wins are strong, sustaining about $500 million. But if you have to find a reason, you can say the deal wins have not expanded. They have been in a similar range. And finally, to top it all, both Persistent and Coforge are the best performing IT stocks, most expensive, trading at about 40 times forward multiples. So that is, of course, doesn't help.
Makes sense, right? And right now, market is basically punishing everything that is not performing well, especially at such valuations. In fact, we also spoke to the management of Persistent Systems. Let's listen into what they had to say.
We want to be a $2 billion company aspirationally. Again, this is not a guidance. By FY27, we want to be at $2 billion. Now, if you do the maths, we have to compound from an yearly compounded annual growth rate at about 19%. It will definitely have some amount of M&A, the acquisition part. Now, depending on the size of the acquisition, we may get there faster. We may have smaller acquisition, bigger acquisition. And to that point, look, at any point in time, we are evaluating multiple different options. We have said our acquisition strategy is twofold. One, Europe as a geography, we are currently at a 8.5 to 9% revenue clip. We have grown Europe at the company pace for the last several years, but we want to take a step change in Europe. We want to grow Europe over the next several years to 15% of our revenue. And that is basically to balance our revenue profile. And also, as we grow bigger, it's a healthy mix to have. Second part, we have said we want to be very well known for what we have always done better, the technology capabilities. Compare the last full year was 14.7%. Now, if last full year was 14.7%, our starting point for Q1 is 15.5%. Again, we don't give forward-looking guidance, but if you extrapolate it, you can do your maths. And we have said we want to increase our margin as we go along by 100 to 200, 300 basis points over the period of time. We are on that trajectory. Many people in the industry are deferring wage hikes by quarters and maybe for the full year. We are not doing that. We have just said we'll defer it by 1 year and that is cast in stone. We are going to give the wage hikes next quarter. And if by the end of the year, if things pan out the way we want them to, maybe we will also take care of whatever we deferred.
The EBIT is going to hit 14% for the current fiscal. And our business, our firm has always seen a sequential increase in EBIT in margins across the quarters. This is quarter one. We've landed at 13.2% despite very strong growth off the back of the ramp up of the Sabre large deal that we talked about. We feel extremely confident that the EBIT number that we will deliver in the current fiscal is going to be 14%. So from our vantage, 5 large deals, a next 12 months signed order book that is almost 47% higher than where it was at the same time last year. EBIT margins profile which should improve very significantly this year. H2 in turn again should be materially better than H1. So the year from a revenue growth perspective and from a margin improvement perspective seems to be turning out to be an exceptional year.
The law of averages finally catching up with both Persistent and Coforge now trading 8% down each after their result reactions. By the way, just before we get to Dr. Reddy's, where Ekta is here to tell us more about how the numbers were and what the brokerages are saying, IEX is now down 20% after the 10% circuit opened up. It went down 15% and now it's down in a 20% lower circuit. And if you check NSE currently, the total number of sell orders that are pending at this lower circuit price comes up to around 4.6 crore pending orders still at this 20% lower circuit. So we'll see how further lower this stock can move as the day goes by. By the way, the stock is in the F&O ban, mind you, so no new positions can be created on the stock here. So go across to Ekta now, who's joining in with Dr. Reddy's, how the numbers were, what did the management tell us, and what brokerages are making of the numbers. Ekta.
Well, overall, a mixed performance, you'd say, for Dr. Reddy's, because the numbers were okay, but the commentary probably was better than what the street was anticipating. So the revenue was up around 11.4%. The street was anticipating around 13% growth. The margins were better than expectations at around 26.7% versus estimates of around 25.4%. But there were some estimates of a higher margin of around 27 to 28% as well. Profit was just about flat this quarter versus expectations of a growth. North America, which is the key business for the company, was down 11% on a year-on-year basis. That is because Revlimid generic did see competition come through, or rather price pressure come through. India did well. It was up around 11%. It was pure organic growth, according to the management, as the Sanofi vaccine tie-up was in the numbers same time last year as well. The guidance as per the company on the US was disappointing. So it was flat to single-digit growth, which is expected for FY26 in the US. But the street is probably expecting that somewhere. The EBITDA margins are expected to be north of 25%. This is despite the competition that would come in for Revlimid generic. India, Europe, PSAI, which is their pharma ingredients business, is expected to see double-digit growth. And the biggest kicker will be the semaglutide launch. So they are saying that they are planning to launch semaglutide in Canada in 2026. So approvals in the second half of this year will be something that the street will watch for quite closely. In terms of brokerages, CLSA underperformed, target price of 1120. According to them, earnings are in line with estimates. Morgan Stanley, overweight call, target price 1298. Jefferies underperformed with the target price of 1100. The Ozempic generic approval in Canada and US filing for one of their biosimilars are two important events to watch out for.
All right, so we'll be watching out for that. Thank you so much, Ekta, for joining us with all those details. That's Dr. Reddy's up 2.5% in trade. But what's not doing well is Mahanagar Gas. That stock is lower by 4%. Remember, it reported numbers on Tuesday. And this time around, it was aided by that one-time provision income that had come by, a reversal that they took. And the company held a conference call yesterday. So while overall commentary looks decent, they mildly cut their guidance in terms of revenues and EBITDA per SCM for FY26. It's a very small cut, not a big one. They talk about high single-digit YOY growth in volumes. Earlier, they had spoken of 10%, and this will mainly be led by CNG. They also talk about EBITDA margin expected in the range of 9 to 9.5 rupees per SCM. So the upper band was earlier 10 rupees. Now it has been cut to 9.5 rupees. The acquisition that they had done, Unison, that's where volumes this time around saw growth of 8.5% on a sequential basis. They have a capex guidance of 1,100 to 1,300 crore rupees each for the next 2 years. And CNG volumes in July 2025, it has been slightly above Q1 of FY26. So that's some positive commentary coming in. We were talking about revised zonal tariffs, and they say that because of this, because they move from zone 2 to zone 3, there will be an impact on EBITDA margins by 0.6 to 0.7 rupees per SCM. On the back of this, MOSL says that they value the stock at 15 times FY27 EPS. This is the cheapest stock in the city gas distribution space, but they maintain a buy rating at 1700. Nomura also has a buy rating with a 1580 rupees as the target price. They say Q1 was below estimates according to them, but volume was something that they like this time around. CLSA says that they have an outperform with a target price of 1710. They say it continues to be the cheapest in the entire city gas distribution space. That's why they have an outperform rating on this stock. But yes, the management talks about a slight moderation there. And that's why maybe the stock is seeing that cut of 4% in trade as we speak.
Got that. Thank you very much for that. Get into break. As we do that, here is a small programming note for all our viewers. As workplace transforms, so must leadership. In Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on the 29th of July, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com and YouTube.
Welcome back. Still another 80 points lower now on the index. So we are below that 25,150 mark, and there are plenty of earnings reactions that we are tracking. At the lowest point of the day now is where the Nifty lies. But on the flip side, we just spoke of Cenor's Pharma, which was the top gainer on the Nifty 500 today after its results. The company's revenue was up 72%, profits nearly doubled from last year. To discuss the quarter gone by and the road forward, you're now being joined by Swapnil Shah, who is the managing director of the company. Swapnil, good morning. Thank you for joining in. You know, at the end of the previous quarter, which is Q4, you had highlighted that you intend to have at least a 50% top line growth, to profit growth of at least 100%. You've at least maintained the top line growth very healthily. Even the profit growth as well has been almost 100%. Do you stick with that guidance for the rest of the year, or considering how you have performed this quarter, you would want to revise it higher?
Thank you. Good morning. So we've achieved 95% PAT growth year over year, which is well within the line of our guidance that we had. I would not want to comment on the further guidance. What we have said, I think we are on track to achieve those numbers this year.
Got that. This strong 72% growth, we can see it was a 69% growth in the regulated markets, 32% growth in emerging markets. Going forward, what is the outlook on both these two markets, and even US? How much did you generate from US in the current quarter?
Yes, so current quarter, I think we are on track to what we have said. Full year we have guided at about 400 crores from the US market. So relatively that will captured in this particular quarter as we speak. What I can tell you, we have a very busy year, both on emerging market as well as US side in terms of product launches, in terms of the pipeline that we have, and that will continue to drive the growth that we have guided for.
Okay, so in terms of US itself, can you give us a sense of what was the growth this time around? How much did you do from US markets from both the segments, be it the retail channel or the government channel?
So currently, our exposure to retail channel is very limited. We would intend to go into retail channel with our acquisition portfolio that we have. We have acquired close to about 20 plus ANDAs from various companies, as you probably know. So that retail piece will start kicking in from H2 of this year. And most of our current product that will go into controlled substance government business, that's about 60-70% of our current business that go into those two class of trade, which will continue to grow both on the CDMO, CMO, as well as our own product side.
Okay, so in the US business itself, especially in the government contracts, how many ANDAs are in the pipeline, and which are the ones which are on the controlled substance from the US? What is the potential pipeline of launches? And if you can give us a sense of what kind of growth are you going to see there? What is the sales estimates that you have from these ANDAs?
So as you know, on the controlled substance side, both the development as well as manufacturing has to be done in the United States. We are equipped in terms of taking up that kind of growth that we have projected for this year and next year. We have installed cages. We have done a lot of installation in terms of catering it to those C2, C3 kind of markets. So to give you exact ANDA numbers will be a little tough in terms of what approval that can come in. But from what we have projected this year, I think largely we'll be able to achieve. Similarly, on the government side of the business, as well as I said, retail, right? Retail as well as specialty channel that we cater to. Both as the guided what we have this year will continue to achieve. And from the US standpoint, particularly from the growth, as we have projected, we'll do about 50% odd on the revenue side from the last year. US will drive that growth. So US will probably be between 50 to 70% of the growth this year as we speak from the last year that we've done.
Swapnil, you have acquired a significant number of ANDAs from Dr. Reddy's in the past, 14 of them, and you've acquired a couple from Wockhardt as well recently. Are there any more ANDAs that you're looking to acquire going forward?
Yes, that would be our strategy, just to cater to the market early on, because typically, the new ANDA filing will take about anywhere between 24 to 36 months, right, from the start of the R&D to getting approval from FDA. With acquisition strategy, we can access market quite early, within 8 to 10 months from the acquisition that we've done. So very carefully, we are looking at the available opportunities, and we'll continue to acquire more as long as it fits into our strategy going forward that we are trying to do for next 2 to 3 years growth strategy.
Okay, Swapnil, just confirming, did you say 50 to 70% growth is what you're expecting in the US portfolio itself?
That's correct.
Oh, okay, all right. So US definitely will be a growth driver. What about India in particular? What is the revenue contribution coming in right now? And what kind of growth are you going to be seeing here? Is there any launch that is expected in this fiscal itself?
Yeah, so we've done first quarter at about 8.5 crores from branded generics in India. We will be doing 50 crore plus this year from our branded generics business. Launches, we keep on launching newer products, both on the hospital critical care segment side as well as new antibiotics the portfolio that we have. So strong growth on that side compared to last year. There's going to be about 300% on the branded generics that we are anticipating this year. We'll continue to drive year after because our base is small. We are not present in all states. Our team is relatively smaller. But as we move forward, we plan to be pan-India with a slightly bigger workforce and approval in multiple specialty hospitals across India. So that portfolio will continue to grow, and we see significant growth from branded generics this year as well.
Significant, like you gave us a number for US, can you give us a number for the generic market or the generic segment as well?
We said, right, we target to achieve 50 crores plus from branded generics to 8.5 crores. First quarter, we've done about 8.5 crores. And our target is to achieve 50 crore plus from branded generics this year.
All right, Swapnil, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Cenors Pharma, very confident of maintaining their growth and also see significant growth in the US markets as well. The stock 12.5% higher in today's session. Take a short break. The market has fallen to the lows of the day now. Discuss a quick chart check with Apurva Sheth from Samco Securities on the other side. Stay tuned.
Welcome back. Well, it's a sharp fall on the Nifty. It is at the day's low. It's a 115-point cut that you're looking at, and it has only intensified in the last couple of minutes itself. We'll talk about individual names, but a lot of action that is happening in the F&O space as well. So let us get in Mangalam to tell us more. Mangalam.
Well, like you pointed out, there is a sharp fall that we're seeing in the frontline indices. Early in trade today itself, we have the Nifty, which is lower. The street was hoping for some sort of support coming in from a couple of these IT names. That hasn't been the case. Nifty Bank is lower as well. And the mid-cap index tells you that the number of stocks which are declining are far more than the number of stocks which are advancing. So the market breadth, we still have the red line above the green line as we speak. Importantly, as we move towards the weekly options expiry, the India VIX, which is at very low levels, was factoring in that the market continues to move in that range, has seen a bit of a spike, a smidge of a spike. So let's see where that goes from here on as well. The active Nifty options tell you that there is a fair amount of resistance on the way up. 25,200 call, very active in today's trading session. Writers believe that maybe, upwards of 25,220, 230, there could be a fair amount of resistance for the frontline index. 25,250 call writers as well, equally active in today's trading session. At the lower level, though, we did see some writing at the 25,150 put, and those who are writing both the 25,150 put and the call, they are hoping for the market to stay in this range of 25,000 to about 25,200. Let's see whether that range sustains or not. Early in the day, but we will keep an eye out on that as we progress towards weekly options expiry. A couple of stocks really stand out. Tata Consumers being bid higher, so a lot of fresh longs being added out there. And we have a lot of short positions being added on names like Persistent, Coforge and Mahanagar Gas. Persistent and Coforge, remember both of them reported a weak set of numbers.
Okay, all right, Mangnam, thank you so much for that. But we'll come back to you in just a bit because Nestle's numbers, those are flashing for you at the bottom of your screen. Net profits have come in at 646 crore rupees, which compares with a poll of 732 crore rupees. The expectation was of a 2% decline, but the profits have declined 16% on a YOY basis. You can see that sharp fall in the stock price as well. Revenues were expected at 5,080 crore rupees. The number should come up for you on the screen, but looks like the profit number, that is something that the street is not liking right now. We do have some commentary which is coming in from the management as well. They talk about how they have delivered a balanced growth in 3 out of the 4 product categories: prepared dishes, cooking aids, powdered and liquid beverages and confectioneries. They have bounced back to volume-led growth. 7 out of 12 top brands grew at double digit. They also talk about the quarter was impacted by elevated consumption prices across the commodity portfolio. They have also witnessed higher operation costs as a result of significant expansion in manufacturing in the last 7 to 8 months. And that is something that has impacted the numbers this time around. The revenues absolutely in line with estimates, but it is the profit number which has seen a decline. Can we go across to Mangalam for a quick take on what the numbers are looking like? Okay, the stock is down 4%, but it's the profit number that the street doesn't seem to like.
Higher costs is what they're saying, right? Finance costs are higher, employee benefit expenses are in line, but the cost of materials consumed is also higher. So it is the higher expenses that have weighed on the operating performance. That they have mentioned that there were some borrowings from commercial banks that they had to take to fund the temporary operational cash flow requirements. That resulted in the higher finance cost this quarter. We'll await the volume growth number, but Prakash Diwan is with us on the phone line. Prakash, thank you for joining in. The numbers, well, if you can say on first sight that it was higher costs that impacted the performance, but it is also, do you see that as a result of the sluggish consumption trends that have also remained all through for a better part of this year?
No, absolutely, Hormuz. See, if the cost spike is one-off, the market will probably take it in its stride. But if there's a genuine issue in terms of inability to pass on higher pricing and hence there's erosion on margins, then there's a concern. And my sense is it'll probably be the latter. See, Nestle is undergoing a significant expansion at its Gujarat facility, and that might take some time before it starts kind of, getting the ROCs to be positive. So that's where, even the balance sheet is stretched. And once that expansion happens, probably things will look very different, provided it gets backed with the demand absorption as well. So I would believe the volume numbers might also not be very encouraging, though the anticipation going into numbers was very moderate. But we'll have to wait to see what's resulted into this cost spike. If it's just interest costs, it's understandable. Raw material is probably only getting benign now. Post-June, so things could probably ease out, but the market will want to understand that.
Oh, absolutely. In fact, let's get in Mangalam as well. Mangalam, higher costs is what the company is talking about. Though they mentioned that coffee prices are expected to remain range-bound at current levels. Cocoa and edible oil prices have stabilized and remain range-bound. Milk prices are anticipated to decrease. What's your take on the numbers?
Well, if you look at these numbers, they aren't anything to worry about. Yes, there was weakness in the top line that the street was anticipating. The EBITDA has been slightly below street expectations. We were expecting some sort of margin compression to come by as well. The net profit, now that's lower than street expectations. A large part of that is on account of a non-cash expenditure. So if you look at their overall depreciation, that has increased this time around from around 112 crores to 156 crores. Why is that? Because 2 quarters ago, we had the Sanand plant of the company come on stream. So as a result of which, the depreciation had increased. The EBITDA margins have taken a slight knock. But, the commentary that the company is given is very positive. Why do I say that? Because coffee prices have come off the peak. Going forward, they would see margin improvement in that itself. Secondly, milk prices, which account for a fair amount of their raw materials as well. As the flush season has begun, milk prices are likely to decrease from here on as well. So this weakness that the company has seen in margins may be on account of 2 factors. One, the inflation in raw materials, which was transitory, and company being stuck with high-priced inventory. So all those things now coming down with the raw material environment looking a lot more benign going forward and the demand environment looking a lot better going forward, these numbers, while the street is seeing a bit of a decline in the stock price on account of reported numbers, the going forward is relatively better. And I believe that maybe, the street will now start looking ahead as against looking behind. And for Nestle, the other big trigger is also Suresh Narayanan. After a great stint, hangs his boots. So you will have a new leader. Manish Pandey joins in, and his strategy is something that the street will be keeping a close eye on too.
Absolutely. Take that point. The stock has recovered as well on the back of that commentary which has come by on the pricing scenario going forward. Prakash, your take now. The company talks about how some prices are expected to moderate, especially for the raw materials, be it milk prices, be it cocoa prices. What do you have to say now?
Yeah, absolutely. So as I said in the beginning, the prices can only become, the environment on raw material is better and benign. I'm not sure about milk as much, but yes, coffee, which had peaked out last quarter, cocoa, all of that could probably just ease out. The other, positive that seems to be the silver lining of sorts is that the company talks about cooking aids, prepared dishes, and powdered and liquid beverages, which is largely Nifty. Those have started to bounce back. Now, that is the first indication of urban consumption getting into place. The rural consumption will still have, the staples and the basics, but these higher-end derivative products are definitely an indication that urban consumption is coming back. And it could only get better post the monsoon for rural as well. So I think, the stock probably could, see one round of bottoming out in terms of this thing. The earnings are showing that. And then, as I said, the Gujarat plant has been significant capex, and that's going to have its impact. But the benefits of that will start coming October onwards. So the market will probably look ahead. As Mangalam rightly said, so will the management.
Very quick yes or no answer, Prakash. You would use this dip to buy because some of them are already doing so.
Yes, absolutely. Because I think the overall consumption basket is very clearly showing signs of bottoming out, and Nestle is probably the poster child of sorts in that upturn. So definitely this will look positive.
Right, Prakash, thank you so much for joining in with your quick take on the results of Nestle. The stock recovering from the lows of the day, but still trading with losses of around 3%. Let's get you a quick chart check as well. Apurva Sheth of Samco Securities is joining in. Apurva, quick take on the Nifty. It's a very sharp fall that we have seen from the highs of the day. We are now below the 25,100 mark. What's your call on the index? You'd use this dip to buy, or would you stay away for now? And what are your stock recommendations as well?
So if someone is an intraday trader, then he can use this dip to buy Nifty for 1 or 2 hours. But otherwise, if a positional trader is trading on Nifty, then I would say it's best to take a holiday for a few days. And because there's not much of volatility, just to give you a stat, the index has been consistently trading. The high-low range of the index is below 1% for the last 19 consecutive sessions. Now, this is something extremely rare, and until and unless this range breaks out, so we are in a range of 25,320 to 24,880. So this is what the range has been on the Nifty for the last 10 days. So once we break out of this range, we will get some clear trend. So intraday traders, yes, they can use this dip to buy, but positional traders can maybe wait or take a holiday. Stock specific actions are there. So first pick is Tata Motors. We would like to recommend it with a stop loss of 690 for a target of 745. It's breaking out of a sideways 1.5 month sideways consolidation. So there's some action kicking in Tata Motors, and MRPL is breaking out of a 5-month long sideways consolidation. So 150 was a strong resistance, and it is taking it out with huge volumes. So MRPL is another pick for the day.
All right. Thank you so much for joining us with those picks and levels to watch out for. We'll slip into a short break. Up next, we'll discuss the market fundamentals and a lot more. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. Let's talk about market fundamentals now. Manish Dangi, CEO and founder, Mosaic Asset Management, is joining us now. Manish, good morning. Thank you so much for joining in. Well, you're not very positive on the growth aspects of India as an economy right now. What explains that? And do you think that is something which will keep the market range-bound or maybe keep it underperforming the Asian peers for a while?
So growth has been sort of weakish for a while, and even though sort of last quarter we saw some uptick, but again, April, May, June was almost all high frequency data seems to suggest that we've had a renewed cycle of slowdown. Actually, somewhat surprising given that it's this leg of slowdown. Actually, at least I did not anticipate. Now, in a setup when, of course, nominal GDP growth is single digit, revenue growth, of course, you're seeing all the numbers coming in, again, single digit, profit growth, 6, 7, 8%. Of course, valuations in India continues to remain expensive. Now, actually, not just in equity, but even bonds, you can't really argue that bonds are very cheap. So to that extent, these are listless markets and unlikely to deliver any significant gains in any asset class, I would argue.
Okay. What about the inflation aspect? We've seen a multi-quarter low inflation. Do you think if we go below that point, it will be worrying? Because yes, inflation should be lower for overall economy, but it shouldn't be so much lower as well. What is your take on that?
I agree. So inflation actually in India has surprised the last 6, 8 months almost all analysts. And inflation is actually the best indicator of growth. So to that extent, you could argue that the growth slowdown in India is getting reflected in lots of disinflation that we see. It is pervasive. It's not just in vegetables that some people seem to argue. It's there in core inflation, very, very apparent. So I guess the only path it leads to is perhaps even more rate cuts in India. So to that extent, I sort of remain very constructive on RBI. I know, as a matter of fact, most bets on incremental rate cuts have been pulled back. But I think RBI would still surprise markets, and you will see an additional 50 basis point rate cut in this financial year.
Manish, the next big trigger globally next week is, of course, the Fed policy. And while it's mostly a status quo that has been priced in this time around, a very interesting observation from JP Morgan came in recently that in case there are future rate cuts, that might turn out to be a sign of weakness more than a sentiment booster. What's your take on that? Do you still expect the Fed to cut twice this year despite the economy being the way it is currently?
So US in some sense is behaving a bit like emerging markets, I'm not stretching the argument, but it is somewhat like emerging market. Dollar is actually weakening. Tariffs, of course, are resulting in the core inflation actually sort of strengthening as we speak, even while growth sort of at margin is actually slowing. So to that extent, Fed's, work cut out for Fed, is a very, very difficult one. There's absolutely no way that Fed would cut rate right now. Now, the competition between more inflation induced by tariff and this growth slowdown, frankly, it's likely that at least in near term, inflation wins, and there could be some more of inflation in the core inflation side of US actually may come in, and to that extent, I think the rate cuts in US are certainly pushed out into the future. Would there be a 50 basis point rate cut? I kind of have been of this view that yes, it would be more driven by, of course, growth slowdown in US. But I think it's being pushed back again by another quarter.
Okay, take that point. Lots to talk about. We are short on time today, Manish, but always a pleasure speaking with you. It's a busy time with a lot happening with the tariff updates as well and now earnings. So we'll speak to you very soon again. With that, we'll slip into a short break. Up next, we'll be joined by the management of G&G Electronics. The IPO opened yesterday for subscription. Stay tuned for that conversation.
Welcome back. On to some primary market activity then. GNG Electronics' IPO was fully subscribed within an hour of opening for subscription yesterday, and currently it's subscribed almost close to 16 times the total number of shares on offer. We are being joined by Sharat Khandelwal, who is the founder and managing director of GNG Electronics, and Ajay Pancholi, who is the director of the company, who are joining in. Gentlemen, good morning. Thank you for joining in. And firstly, congratulations on the response that you have received on the first day and a half for your IPO. You've mentioned that out of this proceeds that you plan on raising, the 400 crores through the fresh issue, 320 you'd be using to repay your debt. Does that now make you a debt-free company after this 320 crore is repaid?
Yes, that's correct. That makes us debt-free company.
And what about the rest of the proceeds? How do you plan on utilizing those?
After providing for the expenses, this will be for general corporate purposes, mainly for working capital only.
Okay, take that point. Mr. Pancholi, let me come to you. You do have substantial revenues coming in from export markets as well. It's around 1,056 crore rupees in FY25. Revenue within India has been 345 crore rupees. So substantial chunk coming in from exports. What kind of growth have you been seeing there? There's a lot happening with tariffs as well. So first up, how much is the exposure to, say, US, which are the other countries that you have exposure to? And what is the growth which is likely in this particular segment?
So we've had a phenomenal acceptability of our product globally. We export to almost 38 countries across the globe. And that's what has been resonated in our revenues historically. We've initially started with a few countries and now export to over 38 countries. US contributes about 17-18% of our exports, and a large part of exports also happens in various other countries across the globe. On the overall growth perspective, we see that we have had a good trajectory and we have a good roadmap ahead in terms of how we see the opportunity going forward. We just need to execute well. On the tariff front, Sharatji, if you may want to just address it.
Yeah, on the tariff front, I think situation is very, very fluid. Still, there is some exemption on computers. But even if the tariff has to come at a later date, because things are very, very dynamic in the United States, changing very rapidly, we still have skill set and cost advantages vis-a-vis things done in America. And tariff will not come on the refurbished; it will come on new as well. So the differential will remain there. US is a very high cost economy. Wage cost per hour is very high. We between India and UAE, we have significant skill set and cost advantages that we carry, and that will remain as competitive in American market. And our business is diversified across United States, Europe, other countries as well.
So you are a refurbisher of laptops and desktops and other products as well. So I wanted to understand, how is it that the exposure outside is more? What is the plan to grow in Indian market? What is the current market share, so to say, here? Who would your competitors be in the domestic market currently?
See, our export share is more because we have gone by the price taking ability. But India remains a very, very important market for us. It's the largest nation on planet and fastest growing economy, very, very vibrant population. Refurbishing is very, very important in this country. It supports e-education, it supports GDP growth. And this is one business which is good as a business, good for employment, good for inclusivity, good for economy in general. Good for general employment. So we welcome, respect all the industry participants, but other competitors that we have are limited to region or selling to a particular set of customers. We are international. We are not. We can buy in the US, refurbish in UAE and sell to Europe, or do the other way around. We can buy in India. We can buy in UAE and sell to America and Europe. So we have multi-country presence. We have no country dependence, no particular set of customer dependence.
Yes.
So we are very unique in this. We buy from long tail, we sell to long tail, so no dependence there, and good levers over there as well. Yeah.
So just follow up on that. I wanted to understand, since India continues to be such a big market, what is the market share that you have currently? Who would your peers be? Just trying to understand the business overall.
Yeah, our market share in India is around, I can say 2-3%. Market is very, very large, so we have very big headroom. Peer comparison, I mentioned we don't have any exact peer comparison. One peer comparison mentioned in our RHP. But see, the people who are selling on a particular set of customers, we are buying from long tail of customers and primarily selling to business as the ultimate customer, business and education as the ultimate customer, India and international markets.
Most of your revenues come from laptops. Are there any plans to diversify into other business lines, Mr. Pancholi? And if I could club in one more question, what is an optimal level of margins that you can face? You are still in the high single digits. Do you expect to go to double digits sometime in the near future?
So we have capabilities across the ICT product suite. So almost 70-75% are laptops. There are computers and other ICT devices that we do. But in terms of capabilities, we have phenomenal capability, and we see a huge runway in these two products as well. So long as your question on margins is concerned, I would refrain to answer anything for this at this point of time, given the situation which we are in the midst of an IPO. So,
no worries. We'll ask you more questions on future guidance and future plans once you're listed. But thank you so much for joining in today, Mr. Khandelwal and Mr. Pancholi. We'll be speaking to you when the stock lists on exchanges as well. Thanks a lot for the conversation today. Time for a short break now. We'll get you more on the markets on the other side of the short break. Stay tuned.
Further fall on the benchmark index, 130 points lower now on the Nifty, below the 25,100 mark now as the lowest point of the day. And in the midst of Persistent Systems and Coforge taking a knock, the other one that has taken a big knock today is Cigniti Technologies. Of course, it is majorly owned by Coforge, and it also reported numbers, and 8.5% knock on Cigniti Technologies as well. Among the benchmark losers, though, Nestle has now extended its losses. We saw bit of a recovery after that management commentary coming in once the numbers were out, but now the stock is down 5% at the lowest point of the day. The top loser on the index is Nestle. The other one is Trent. And that is after the Goldman Sachs downgrade that came in earlier in the day, where they have cut their target to 5,500 from almost 7,000 earlier. So that stock is down 3%. Some of the other losers on the index, Shriram Finance, Hero MotoCorp, but not significantly, just a 1 to 2% cut that we are seeing on these names. But IEX, just before we take your leave on trading hour, now it's down 26%. The circuit has opened, and at the lowest point of the day now is IEX still pending or sell orders pending of almost 4.5 crore sell orders that are pending, a 26% cut on IEX. But we take your leave on this edition of Trading Hour, leave you with the markets at the lowest point of the day. From Rima, me and Sonal, thank you for watching. Halftime report on the other side.